Hey everyone, welcome to the Admiralty Capital Crypto channel, your go-to destination for all things crypto. Make sure you hit that subscribe button and ring that notification bell so you never miss out on our video updates. A reminder that nothing we say on this channel constitutes financial advice. We're not registered financial advisors, and make sure you always do your own research before investing your hard-earned money into anything that you buy. So in today's video, we're going to give essentially a crash course in what crypto is. It's important when starting out in the crypto space that you understand the very basics before jumping into your investing journey. Today, we're going to give you an overview on what is a cryptocurrency, a brief history of Bitcoin, where to keep your Bitcoin, what a crypto exchange is, and what decentralized finance means. These topics are actually only about 1% of the crypto information that you should have a solid grasp of before doing any crypto investing. All right, so let's jump in. What is cryptocurrency? Well, cryptocurrency is a type of digital or virtual currency that uses cryptography for security and operates on decentralized networks, typically based on blockchain technology. And unlike traditional currencies issued by governments and central banks, cryptocurrencies rely on a decentralized ledger to record their transactions. The most well known cryptocurrency is Bitcoin, which we're going to talk about shortly, but there are thousands of others and often referred to as altcoins. Cryptocurrencies enable secure peer to peer transactions without the need for intermediaries like banks, and they utilize cryptographic techniques to control the creation of new units and verify the transfer of assets. All right, so a term you'll hear all the time when entering the crypto space is the blockchain. So, what is the blockchain? Well, the blockchain is a decentralized and distributed ledger that records transactions across a network of computers. On the screen there, I've got a image that represents a brief explanation. So the blockchain operates on a network of computer nodes that are distributed globally. Each node on the network has a copy of the entire blockchain. When a transaction is requested or when a user initiates a transaction, it is broadcast to the network. The transaction contains details like the sender receiver and the amount of cryptocurrency involved. It goes through a verification process where transactions are grouped together into blocks. Miners or validators on the network compete to solve a complex mathematical puzzle to validate and add a new block to the chain. It then goes through the consensus mechanism, commonly referred to as proof of work or proof of stake, and this ensures that all the nodes agree on the validity of transactions and the order in which they are added to the blockchain. Cryptography plays a crucial role in securing transactions and controlling the creation of new blocks. Each block contains a reference to the previous block, i.e., the hash, creating a chain of blocks. Immutability is once a block is added to the blockchain, it is extremely difficult to alter this. Immutability is a result of the cryptographic link between blocks and the distributed nature of the network. The decentralized nature of the blockchain enhances security. There's no single point of control or failure, making it resistant to hacking or fraud. All participants in the network have a synchronized copy of the blockchain, and this transparency ensures that everyone can verify transactions, fostering trust in the system. Another term you'll hear is smart contracts. Some blockchains, like Ethereum, support smart contracts, which are self executing contracts with the terms of agreement directly written into the code. Smart contracts enable the automation of complex transactions and processes. In summary, the blockchain is a decentralized, transparent, and secure system for recording and verifying transactions. Its distributed nature, cryptographic principles, and consensus mechanisms contribute to its trustworthy resilience. Up here, you can see transaction is requested. A block representing the transaction is created. The block is sent to every node on the network, and nodes validate the transaction and receive a reward for proof of stake or proof of work. The block is then added to the existing blockchain, and the transaction is complete. All right, so here's a super simplified image of the blockchain and one that probably represents the majority of the listeners' interactions with cryptocurrency. So A wants to transfer money to B. The transaction is represented as a block. The block is broadcast to everyone in the network, approved as valid from everyone in the network, and then the block is then added to the chain. It creates a transparent record of the transaction, and then B receives money from A. All right, the number one and the founding father, Bitcoin. Let's talk Bitcoin and let's start with just a brief overview of Bitcoin's inception and where it's at now. All right, so Bitcoin, 2008, a person or a group using the pseudonym Satoshi Nakamoto, publishes the Bitcoin white paper titled Bitcoin, a peer-to-peer electronic cash system. You can read this, it's available online. Fast forward to January 3rd, 2009, Nakamoto mines the first block of the Bitcoin blockchain, known as the Genesis block. And on January 9th, the first version of the Bitcoin software is released, and the first transaction takes place between Nakamoto and computer scientist Hal Finney. 2010, the first commercial transaction occurs when a person purchased 2 pizzas for 10,000 Bitcoins. 2011 to 2012, Bitcoin starts getting more interest and starts to be seen mainstream. In 2013, Bitcoin surpasses $266, but then crashes down to around 50, and it's used in various online and offline merchants who have begun accepting Bitcoins. This is when it got pretty mainstream. 2017, we saw Bitcoin's price rise, reaching close to $20,000 in December of 2017, and then it has a massive price correction, dropping back down to around 3,000 USD by the end of the year at 2018. The halving happens. A halving in institutional interest Bitcoin undergoes its third halving, reducing block rewards to 6.25 Bitcoin, growing institutional interest with companies like MicroStrategy and Square investing in Bitcoin. 2021, we saw that massive bull run, and it surpasses its all-time high and hits 60,000 in April. And then moving forward to recently, market developments has continued regulatory scrutiny coupled with efforts to integrate Bitcoin into traditional financial systems, and it's seeing ongoing technological developments and debates within the Bitcoin community. So over the last year and a half, 2 years, Bitcoin dropped, but it's back up, sitting around the $30,000 US dollar mark. Yeah, so at time of recording this video, Bitcoin is sitting at 37,817 USD, which is around the 50,000 plus AUD mark. And you're thinking to yourself, I want to own a Bitcoin, but where do I keep it? Well, you need to start looking into and learning about hard and soft wallets. There are tons of options out there for wallets, and you need to understand the difference between a hard wallet and a soft wallet, and an exchange as well. Personally, I use exchanges, and we use the Ledger. Have never had an issue with Ledger and find them super secure. All right, so I've thrown up this graphic here, and you can see 4 different types of wallets. So you've got your software wallet. Software wallet is software used on your desktop or mobile phone, similar to a digital bank account for your cryptocurrencies in order to manage, send, and receive your coins. So I'd say something like MetaMask is a software wallet. You got your web wallets, which are hot wallets and hosted by third parties such as cryptocurrency exchanges, online for increased user convenience. So we're talking exchanges later on, but an example of that is your Binance web wallet, SwiftX here in Australia, Coinbase, etc. Then you got your cold wallet, which is any type of wallet that is not connected to the internet, such as a paper wallet or a USB hard drive. And then your hardware wallet, such as your Ledger Nanos, so devices specifically designed to safely store cryptocurrencies, and they are highly secure and probably the best way to store your funds, which is exactly true. So as I just mentioned, you've got exchanges as well. So something that you'll see in the media a lot recently is references to crypto exchanges. Crypto exchanges such as FTX, Binance, SwiftX, Coinbase, Crypto.com are all your different exchanges. So what do they actually let you do? Or they let you store your crypto on their exchange and essentially trade them live. So you can buy and sell whenever you want. But the downside to trading on an exchange is that you don't hold the keys. So if that exchange goes and you don't have access to it anymore, you've lost all access to your crypto, which we saw in FTX, where they were actually using members' crypto, members' funds for their own trading without the user's knowledge. So benefits, you can buy and sell very easily, you can send and receive very easily, and you can basically watch your profits or losses daily. Downside is they are risky. However, with the new regulation coming in and the popularity around crypto becoming so mainstream, exchanges are under a lot more scrutiny, and so they're putting in place a lot more of insurances so as to not let down the users. Essentially, they'll hold your funds one for one, or they will agree that they will not use your funds or your crypto for their own trading unless you approve or give them access. Others, like SwiftX here in Australia, are regulated and have to abide by Australian law, so they're not so much in the wild, wild west. Highly recommend you do your due diligence when looking for an exchange and make sure that you are using one of the mainstream ones. I do not recommend using a up and coming exchange that has very little information on it. You just run the risk of losing all your money. All right, so we just talked exchanges, and now another term that you'll see a lot is DeFi, or decentralized finance. You'll see this term pop up a lot when the media is referring to cryptocurrency or cryptocurrency exchanges. So let's jump in, because this is exactly what you need to understand, and this is why cryptocurrency is so important. All right, so let's talk about DeFi, or decentralized finance. It's a financial system that operates on the blockchain technology and is designed to recreate and enhance various traditional financial services without the need for traditional intermediaries such as banks or brokers, and it aims to provide an open and inclusive financial ecosystem that is accessible to anyone with an internet connection. And here's just some aspects, right? So blockchain technology, DeFi is built on it, on the blockchain platforms, most commonly Ethereum and other blockchains, Bitcoin, etc., etc. It ensures transparency and security of financial transactions. It's decentralized, so unlike traditional finance systems that rely on a centralized authorities, DeFi operates on the decentralized networks of computers, also referred to as nodes, and this eliminates the need for intermediaries and reduces the risk of single points of failure. You've got smart contracts. So DeFi relies heavily on smart contracts, which are self-executing contracts with the terms of the agreement directly written into the code. Smart contracts automate and enforce the execution of financial agreements, removing the need for intermediaries. It uses open source protocols, allowing anyone to inspect, contribute, and modify the code, and this fosters innovation and collaboration within the DeFi community. DeFi provides lending and borrowing services without traditional banks. Users can lend their cryptocurrency to earn interest or borrow assets by providing collateral. These transactions are all facilitated by smart contracts. You've got decentralized exchanges, also referred to as DEX, and DeFi includes the decentralized exchanges that enable users to trade cryptocurrencies directly with one another without the need for an intermediary. So you're talking your Binances, your Coinbase, Crypto.com, SwiftX, etc. Stable coins is another aspect, so which are cryptocurrencies pegged to the value of traditional fiat currencies, and they play a crucial role in DeFi. They provide stability and a familiar unit of account for users engaging in decentralized financial activities. And then you've got such things as like asset management, yield farming, etc. So whilst it's decentralized, DeFi is not without its challenges, including smart contract vulnerabilities, regulatory uncertainties, which is a big one in the market at the moment, and it's also susceptible to market risks. Make sure you exercise caution and conduct thorough research before jumping into this world. However, DeFi is a rapidly evolving space. Its growth reflects and a shift towards more open, accessible, and innovative financial systems outside the traditional banking infrastructure, which I think is why it's such a hot topic at the moment, right? So this is taking the power away from the big banks and returning it back to the people, which is how finance was originally designed, right? So instead of the top 1% holding all the power and all the wealth, it's redistributed and everyone is aware of the financial system, essentially. All right, guys, thank you for sticking with us throughout this video. Hopefully you've learnt a little something about what crypto is. Make sure you like, subscribe, and share with anyone else that you think could benefit from this. Stay tuned, because we're going to start doing some videos around coins and coin reviews, especially with the upcoming 2024-2025 bull run, and how we're going to position ourselves to be profitable in this time.